Quote, we are raising our gold price target to US dollar 3,500 across our forecast horizon and remain long the metal in our global and Asia asset allocation. We are also lifting our upside and downside targets by $300 to be 3,800 and 3,200 respectively.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, I'm Vince Lanci. It's Monday morning. This is the Gold Fix Market Rundown. Today we'll be discussing China's insurance buying as being locked in context of a UBS report that we'll be sharing with you. 10-year yields are 444, up 5.5. The dollar is 99.52, down 25. The S&P 500 is 54.25, up 64. The VIX is 33.35, down 4. Gold is 32.23-ish, down 14. Silver is 32.25, offered 3 cents lower. Copper is 458, up 5. WTI is 62.30, up 71. Natural gas is 351 and change, down 0.5 percentage point, which is basically a penny and a half. Bitcoin is 84,890, up 1,200. Palladium is 933, up 18. Platinum is 948, up 5.5. Gold, silver hovering below 100. Soybeans 1030, down a penny. 1036, I should say. Corn 483, down a penny, a little bit more. Wheat 561, down 5 cents, almost a full percent. Okay, if you're looking at the board, that's the sign of a market that is expecting some sort of stimulus or relief or easing from the Fed. Industrial commodities are up. Even silver's up, right? Industrial commodities are up, stocks are up, bonds are up, the dollar's down. And that's it. So whether it be hope or reality, we'll find out soon enough. Okay, homepage. We have about 9 stories this weekend. And of the 9, here's 3 that we think are very interesting. We're going to talk about China's insurance pilot plan, how it's really a mandate. That's the Sunday founders discussion that we shared with everyone, with premium, I should say. Lower left-hand side, American gold is German gold. That's a piece that centers on repatriation of gold into the U.S. and what the purpose of it is. And the top left-hand side is a founders post. We just, over the weekend, received some information about Goldman's new upgrade, and we shared that with founders. We'll be going through that again in more detail today for premium. Again, those are the posts from over the weekend that we think matter the most. China's insurance pilot plan is really a mandate. UBS raises gold targets by $500. American gold is German gold. Founders, Goldman re-raises. We said that already. And Hartnett, all the way at the bottom, believe it or not, says to stay short stocks until Powell pivots. All right. The main event, UBS gold analysis. China insurance buying locking in. UBS's CIO put out a brief note late last week as an entree into a longer note. And that it's titled, Taking the Gloves Off, Raising Our Forecast. Quote, we are raising our gold price target to US dollar 3,500 across our forecast horizon and remain long the metal in our global and Asia asset allocation. We are also lifting our upside and downside targets by $300 to be 3,800 and 3,200 respectively. So that's basically their range, their risk range. 3,200 they think is a base case now for 2025, and 3,800 is a top side. Just a quick note, other banks have higher top sides. Goldman as high as 4,500, but that's a separate conversation. Staying with the bank, another excerpt. Aside from safe haven demand and tactical speculators positioning, we see signs of a more structural shift in gold allocations. For example, Beijing allowing insurance funds to invest in gold and central banks systematically raising gold's share of total reserves. This significantly supports demand, while supply is unlikely to respond much to higher prices. There's a lot in that paragraph. It's essentially their bigger report consolidated into one paragraph quite nicely. And you can lose a lot of the emphasis uh, of it because they're just trying to get something out and give people a summary. But without going through all of it, but just in a cursory fashion, the key word in this sentence is structural, right? That means China's market structure is changing to encourage gold to be owned, specifically insurance funds. We're going to focus on the word allowing. Allowing is the word that they use. Encouraging is the word that we used last week. And mandating is the word that we're going to use today for this very brief observation. Okay, so central banks systematically raising gold's share of total reserves. That's right. Where once we thought that gold was being bought by central banks, everyone thought that gold was being bought by central banks, uh, and they would stop buying at a point. Well, they're not. And they're not because they're changing their mix of reserves. They are literally de-dollarizing. They're diversifying. That's the word you'll hear is they're diversifying FX reserves. They're de-dollarizing. They're not selling. Anyway, you get the point. Okay, so for example, Bank of America says they could go as high as they should be about 30% of their reserves when this is over, and it will take anywhere from 2 to 5 years. So that's not something that's going to make gold spike to 5,000 tomorrow, but it raises the floor. And then this sentence here, significantly, this significantly supports demand, while supply is unlikely to respond much to higher prices. That's right. That's because the supply of the miners is scrap, and that's being spoken for as well. Now, another observation we want to make, which is very specific to the title, 250 to 300 tons of gold supply will be taken off the market. That means fresh mining supply indefinitely by end of 2025 as mandated, that's our word, by China's governing party to its insurance industry in continuing process of gold liberalization and de-dollarization. We had a conversation. What are we talking about there? We had a conversation with Bai Zhaozhen, a written conversation. And we were trying to get some insight into him about China's change in plans. You see, around March 25th, gold started to rocket again, and it coincided with an analysis that came out. And that analysis, coming out of China, was about the insurance company's plan. And it went from being the short and long of it is China announced that after the pilot plan is satisfied, we're going to ramp it up to 5%. We're going to include every insurance company. And that's step 4. Step 1 is 1%. Step 2 and 3 are essentially them saying, hurry up, get it done now. We can't really wait much longer. Now, I'm making it a little bit hyperbolic, but the fact of the matter is the 1% cap that those in the know are talking about, the 1% cap, insurance companies can only put 1% of their assets into gold. That wasn't a cap, that was a mandate. They want them to have 1% of their assets in gold by the end of 2025. So pilot programs for China are not really tests. We're rolling it out and we're going to stress test it. And we can't stress test it unless you people buy it faster. So I think that might be one of the reasons that gold started to take off starting March 25th. And one of the reasons that the bullion banks, began to roll out higher prices for gold. We have more on that. We have more on the UBS aspect of that, and UBS raises gold targets $500. The two charts there are from their longer report, which we're not sharing. Visible gold stocks in London are lower, probably even lower than that. visible is not available. I think they're being very careful with their words there. And there's the COMEX gold intake coming in. So there you have it. Moving on, market news. U.S. chip makers are outsourcing manufacturing will escape China's tariff U.S. chip. Uh, we highlight that because if you're trying to figure out what's going to get tariffed and what's not, if your industry is important for the U.S. economy, it will not be tariffed. So we're not going to tariff, or at least not temporarily going to tariff. We're not going to tariff energy uh, uh, on a global basis. We're not going to tariff things that help our economy go, like things that make iPhones work on a global basis. We are going to tariff energy on a case-by-case basis. We don't like Venezuela, tariff it, or whatever you want to call it, sanction, right? So globally, you only tariff that which you do not need. You do not tariff what you need. So you tariff pistachio nuts from Iran because, or globally, you tariff pistachio nuts because who makes them? Iran and Turkey. You're like, I don't give a shit about them. We have our own, right? You do not tariff critical minerals. You do not tariff the things that you need to grow your manufacturing economy. So you can see the flip side of that is China is not going to tariff U.S. chip makers because China needs our chips. So what we have that they need will not get tariffed, and what we need that they have, we will not tariff. And that's how it works. That's really how it works. It's what you need versus what you want. And then after you do your blanket tariffs, you you do carve outs with individual countries, and that's what Trump is doing. Rather, I think sloppily. I can't say that Trump is doing it sloppily, but I can say that voices that he's let loose into the wilderness are not doing a good job of it. Anyway, so there you go. That's the comment about the tariffs. Data on deck, retail and housing this week. You can see that's all the data. Summary and final market check. This week, last week, the end of last week, we saw several important bank reports come out. UBS, JP Morgan, Goldman Sachs, and probably others that we haven't seen yet. Those reports signify a realization and a ramping up of locked-in demand by China, as well as increasing reliable ETF demand out of the West. Those things in combination are raising the floor and right now raising the ceiling. We would say that this week will probably be dominated by, looking at the markets themselves, here, put some charts up for you. This week will probably be dominated by looking for the concerns about the Fed to do something to bear fruit. And that could happen, but we need a stable bond market first. And one of the ways you stabilize a bond market is by removing tariffs on Apple. Another way to do it more substantially would be possibly having private conversations with your trading partners like Japan and Europe. But one thing that will happen if they can't get other things to happen will be a way to stabilize long-term bond yields is yield curve control. And we've talked about it before. Yield curve control is a way to create inflation if you want it. It's also a way to stop runaway long-term bond yields. So yield curve control, if you're not familiar with it, is similar to quantitative easing in that it's targeting to keep your long-term bond supported. If you do it, the main difference between quantitative easing and yield curve control is quantitative easing targets volumes. We're going to keep buying bonds until we decide we don't have to buy them anymore. And that's why you have all that extra money in the economy going into stocks during QE. Yield curve control is a game of chicken. Yield curve control says we're targeting a rate. It's not going above 4.5%. And every time it gets there, we're going to buy bonds until we break you. So it becomes a game of chicken. And Japan had done that for years. It also creates inflation, but it hides it in the bond market. Now, I'm not sure if those things will happen, but those are the nuclear options that the U.S. has, and they will do them if they have to. The markets, top right-hand side, these are weekly charts. Gold is had a great week, obviously. It looks like visually a little bit of a capitulation, but if you look at the capitulations that gold has had over the past year and a half, you'll note that the capitulations are met with sideways movement, not big drops. Maybe big drops for a day. Left-hand side, silver a little more volatile, but silver is going to recover. You're probably going to see the gold-silver ratio drop significantly if the Fed continues to, or if the markets continue to believe that the Fed will ease. Lower left-hand side, that's the Swiss franc. We're watching that particularly because of the safe haven currencies, the yen, the Swiss franc versus the dollar. Gold is not outperforming the Swiss franc. So that would indicate to us that there's more upside to gold out of Europe. There's more buying in Europe for gold that hasn't bought yet. And they will buy if the ECB cuts and the SMB cuts, and those entities are very likely to cut, not 100% guarantee, but very likely to cut, because, well, if this continues, their currencies are going to continue to strengthen, and that will just cause greater recessionary risk for them. They don't want to be safe. The euro and the Swiss franc don't want to be safer than the dollar, because safer than the dollar means recession for them right now, and they can ill afford to have one. Japan as well. Lower right-hand side, 10-year yields, explosive week on the yields, right? Cause for alarm. The market is pausing today. We'll see what happens. I'm Vince. Have a great day.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.